Hi, I'm Nate, and welcome to Stratum, the most powerful, versatile tax planning and projection system on the planet. Last time we were here, we introduced you to John E. and Jane E. Johnson. We imported a tax return for them, which populated the majority of their core data. I then manually added an IRA and a brokerage account, and that gives us a starting point on what their forecast might look like. This is assets using a withdrawal rate method. In this case, it defaults to 4%. And I can also see what that does to their income. Retirement starting here in 2036, Jane retiring then in 2038. Not that that's of much consequence because she has no earnings. So it doesn't have a whole lot of impact on the plan. And we can see Social Security kicking in and a fairly steady income from assets, but not a structured income. So let's structure the income to start with. Rather than a 4% withdrawal rate, let's just give them $125,000 a year. Let's make that their net, which means we'll need to gross up just a little bit for taxes, and let's index it with inflation. All right, we can see what that funding looks like. Gross funding is the total of all of those income items, with the black line being our net income, tracking at about that $125,000 mark. Assets also reshifted. You can see those are depleting here around 2056, 57. That gives us a base to start from. Now, why is that important? The way that the asset withdrawal model works using a withdrawal rate approach is fine, but it's less structured. It's also, interestingly, highly efficient because we take a little bit of each one of our tax pools over time. It may or may not be realistic. And for the case that we want to illustrate here today, we want to keep our income consistent, which doesn't happen under a withdrawal rate model when the assets start moving around, right? So this way we get a consistent income level. Let's play with that. So now we've got asset structured this way. Let's do one thing. Let's look at what a Roth conversion might introduce. Let's go ultra conservative with a 12% max limit. And that results in about $137,000 of conversions with a $14,000 tax. That saves us $66,000 net in nominal terms with a net present value of $6,000. So let's go with that. Let's see what that does. Notice I'm looking at the base view. If I swap that over here, I can see those Roth conversions hitting right there. And I even get just a little bit of a summary view this way, where I can see those same numbers in savings on taxes, and I can also see how that impacts some other elements, including my average tax rate. Notice I'm insolvent in 2057. We don't need to focus on that here. That's not the point of the discussion. It does mean that there might be some other planning techniques that need to take place. But from a tax efficiency perspective, this is what I wanted to highlight. Rough conversions are probably modeled by just about every planning system out there. However, the way that they're modeled differs substantially. And I will go out on a limb and suggest that for the most part, they do a reasonably good job of modeling the in-year conversion. So if I'm looking at whether to do one right now, 2025, I can pull up my tax analysis and figure out what bracket I'm in. In this case, I'm 22%, which means I have no headroom to do an additional Roth conversion within that within the 12% that I established. But that would show up here, and I can see the net impact of that, and I could model that as well. That is probably the table stakes, right? That's kind of basics in year modeling. It's the out years that matter. And here's why I say that. Let's take an extreme case, and let's just say before we do this raw conversion that this client is interested in giving all of their tax deferred funds to charity through a QCD. Now, relevance in this case is low, obviously, because they have a funding problem to begin with, so they're not in a position to give it all away. But the point remains the same. The out years are one of the primary indicators or dictators to determine what should be done with the Roth conversion or whether the Roth conversion should be done. In the event of a QCD, the taxes on the tax deferred account will be zero, regardless of what the average tax rate is during those out years. So we kind of miss the point if we ignore the out years. Now, that's an obvious case. Let me paint one that's maybe a little less obvious. If the client is in a situation where RMDs are not problematic, then a Roth conversion is less compelling. Now, again, at the surface, we can envision this, but can we model it? Most systems will show you some kind of an asset projection, maybe some kind of a a tax simulation, perhaps as a shadow accounting methodology. Most also use some kind of an expected or average tax rate, which, look, I'm not saying those are irrelevant, but they miss some of the finer points. They miss some of the precision and some of the personalization that's really important when you're dealing with your clients and understanding what they're going to do with their money, modeling those out years. Now, Stratum's different that way, and here's what I mean by that. If I put this back in the alt mode, this shows what's happening with the Roth conversions. We can see those happening here in these years. And not only that, but I can audit it right down to the year and the dollar. So here I can see some money moving around in John's tax deferred accounts. And if I drill in, I can see where those conversions are happening to the dollar. I can also come back on the other side and see where they're being deposited on the other side in the tax-free world to the dollar, 100% auditable. I can see how that affects their own income numerically or through some kind of visualization like a chart. And I can see exactly how that impacts their taxes. Watch what happens. These low tax rate years right here, bracket to bracket, give us an opportunity to take advantage and move the tax liability forward from these out years. Look, model the whole thing. Model the out years along with the transition years or the conversion years. Show your client really what the conversion is all about and whether it actually makes sense for them. That's a primer. More to come. Thanks for being here.